Welcome to the August 2024 monthly motor checkup. My name is Dave Lundgren. I'm the Chief Market Strategist and Portfolio Manager here at Motor Capital Management and Research. The Black Plague, the Renaissance, and the aftermath, also known as record volatility, 8-day positive streaks, and their aftermath. Before we get started, let me just quickly give you an opportunity to view the important disclosures. The Black Plague, the Renaissance, and their aftermath. So since our last update, we have witnessed the largest one-day spike in the history of the VIX, quickly followed by a rare 8-day streak of one-day gains. This is really reminiscent of the mid to late 14th century. Bear with me, as in how the death and destruction of the Black Plague passed the baton of change over to the wonderful cultural and artistic renewal of the Renaissance. Despite its horror, the plague itself fortunately did not last nearly as long as the Renaissance. And as destructive as the Black Death was, it did little damage to the structural underpinnings of society. Indeed, the Black Death, in many ways, planted the seeds of positive change in Europe, altering social norms and the leadership regime throughout the Renaissance and beyond. Hopefully, you're seeing my messaging here. Our thinking is that the recent volatility, while scary and brief, just like the plague, will pass the baton to lasting and positive change in the future market trends and leadership. And I think the 8-day streak is just the beginning of that change. So let's take a look at the volatility spike. And as horrific as it was, and it was, the S&P basically plunged over 8%, causing the VIX index itself to surge 330%, driving the VIX curve to a literally unheard of 1.9 times. And this is essentially the difference between the 1-month volatility and the 3-month volatility. And it's just the spread between the two. And normally you can see that this relationship is below 1. And the reason being that people are usually more concerned about the future, the far distant future, than they are about the present, the very near future. And so because of that, longer term volatility tends to be higher than shorter term volatility. And so therefore the ratio between the two, the 1 divided by the 3, tends to be below 1. So when people are really, really concerned about the very near future, that's when you get the 1-month volatility spiking well above the 3-month volatility. In this particular instance of 1.9 times was extremely high in terms of the ratio between the two. And this took place over just 3 days. This sort of volatility plague, if you will, took place just over about 3 days. And then that quickly gave way to a 8-day streak of positive gains. And ultimately, at the end of it, leaving the market roughly where it was before the whole thing started. When I say roughly where it was when the whole thing started, that can mean a lot of things. But for me specifically, and as you've watched these videos and read our research over time, you know that the way I think about that is what's the structure of the market. And what we felt before this whole thing happened was that the structure of the market, which you're seeing here as of July 19th, basically this section here was presented in last month's video. You can see that the majority of charts across the 3 timeframes were in an uptrend. And across the 3 timeframes, the biggest trend stage across these 3 timeframes was uptrend. And when I say across these 3 timeframes, I'm talking about long-term, meaning quarterly, medium-term, meaning monthly, and short-term, meaning weekly. So the structure of the market at the time was quite positive, not super robust, but it's certainly not bearish. And so all of this translated over into the risk gauge, which includes not just these price trend inputs, but also relative performance, momentum, breadth, and volatility. When you pull all of those things into this risk gauge, you get a market that's on the brink of entering risk on across multiple timeframes. And that would be, of course, a very robust bull market, which we've been arguing in these videos and in our notes to clients that we haven't had for a number of years, actually, since before the peak in 2021. But the point was that back in our July video is that this is the structure of the market. And so come what may, whatever weakness we get, we want to be buying of it. Now, of course, our view was that we were going to get weakness in through September and perhaps October leading up to the election. And that's weakness that we wanted to be buying because of this structure that you see here. You know, when you get structure that looks like this, all it's telling you is that when you do get weakness, whenever you do, you want to be a buyer of it. Now, looking at these models after the volatility spike, this is what we're looking at today. Certainly, when you consider what happened, not bad, all things considered. We still have the risk gauge here. It's just hovering just below risk on. So when you consider what happened, the structure of the market clearly survived. And I think that's the most important thing. And so from here, The structure did what it needed to do, kind of navigate us through that very volatile moment. And now we are sitting here with a structure that is still remarkably resilient in the wake of all that volatility. This is the one thing we want to keep an eye out for. At the current time, in the short term, we did have a lot of trend breaks on the weekly chart. It was sort of unavoidable in the throes of that volatility surge. We did break a lot of charts. And so we still have the largest trend stage is a downtrend. So on the weekly chart, the largest trend stage looks something like this. It's a clear downtrend. And that's fine because it's the weekly chart and it's in the context of these longer term charts that still are quite constructive. And beyond that, although this is the largest trend stage in the weekly time frame, overall, most trends are in an uptrend. So if you add up all of these, you get 54%. So yes, this is the biggest, but in aggregate, we're 54% uptrends. Considering what just happened, that being the highest volatility spike on record, this is really great structure. So here's the sort of paradoxical reality of these volatility surges is that when you get these volatility events, they tend to happen more frequently in bull markets. And to be honest, I was kind of surprised by this data when I put it together. But what I mean by happening in bull markets is you can see that here. What we're showing you is what percentage the market was by the time or after that volatility surge happened. So the market drops a fair amount, causes volatility to spike. What we're looking at here are the 20 largest volatility spikes since the 1990s. And when we look at those top 20 surges, what we see is down here at the bottom, the median distance from the 52-week high is -4%. And the median number of days since a 52-week high was only 8 days, so just over a week ago. So this means that most of these 20 volatility surges happened during bull markets because this is, you're basically very small percentage from the 52-week high and just a few number of days from a 52-week high. So you're typically in the throes of a bull market when these volatility surges happen. And I think that's the reason for why these volatility surges, although they're violent, they tend to recover so quickly because most of them happen in bull markets. And what ends up happening in the end is you get these very positive forward-looking returns. So 73% of the 1 month returns after a volatility spike, 1 month, 73% of them are up. And that's well above average in terms of positive returns in any given month. The median gain is 2.35%. And then when you look out to 6 months later, again, we're looking at here, 6 months later, the median gain is 8.6%. And that's a little bit less than the median gain for an average year. So you get almost a 1 year return in the 6 months following these volatility surges. So it's very paradoxical. You would think that these would be very upsetting to markets and that they would be very transformational and cause bear markets to ensue, but that's just not the case. 86% of 6-month periods of time after these 20 volatility surges, after these 20 volatility surges have actually been up. Very counterintuitive, I would think, for most. Certainly it was for me when I was doing the work. Now, one could look at this and say, okay, well, that's fine. I get that volatility can plant the seeds for better outcomes. But what about the most recent volatility? I mean, this was a record surge in volatility, and it was 2 back-to-back. So now we have, instead of 20 volatility surges on this list, we actually have 22. And what we're doing is we're showing you the 20 that have happened where we can show you the forward returns, plus these other 2 that just happened. Right? And we don't have the forward returns, but we can tell you that they're on the top 20 list. That has to be bad, right? And it turns out to not be. This pink line here was the former record in volatility, and you can see that we had 7.8% gain, which is not too much less than the average gain under normal non-record extremes. And then we also have these 2 here. These 2 blue lines are actually back-to-back volatility surges. So two of the top 20 happen in the same incidents. And not only that happened to be another August, and it also happened to be a Friday and Monday combination, just like the one we just had. So let's look at these 2 scenarios. The question is to consider is that this particular one, this back-to-back volatility surge did end with a 6-month decline of 5.3%, which is obviously not catastrophic, but it's certainly one of the worst performers. But what we can say about this is that this, in my mind, happened because 2015 actually was a bear market. So let me show you what I mean by that. Thanks so much for watching this clip of the monthly motor checkup video. We appreciate your interest in our research, and we hope that you are finding it helpful and informative. If you'd like to continue watching this video, as well as access our most recent monthly motor checkup, sign up for a free 30-day trial to all of our research at motorcmr.com. You'll find a link to our website in the description below. As always, like and subscribe to be notified of future content.